Ever wondered why some people seem to make a fortune in the stock market while others lose everything? To begin to understand this, we need to delve into the intriguing world of stocks. The stock market is a vast, bustling universe where shares of public companies are bought and sold. It's a bit like a massive global marketplace, but instead of buying fruits or clothing, people are buying and selling pieces of companies. So, what exactly is a stock? Well, when you buy a stock, you're actually buying a small piece of ownership in a company. This makes you a shareholder. Companies issue stocks to raise money for various reasons. Perhaps they want to expand their business, launch a new product, or pay off debt. Why do people buy stocks? The primary reason is to make money. As a shareholder, if the company performs well, the price of your stock may increase over time. You could then sell your stock for a profit. Some companies also pay dividends. That's a portion of the company's earnings distributed to shareholders. So, owning stocks can provide two potential sources of income: price appreciation and dividends. However, it's not all smooth sailing. The stock market is notoriously volatile, meaning stock prices can fluctuate wildly in a short period. If a company performs poorly, the price of its stock may fall, and shareholders could lose money. Investing in stocks is a risk-reward game. The potential for high rewards comes with the risk of significant losses. But don't let that scare you away. Understanding the risks and rewards involved in stock investing can help you make informed decisions. It's also important to remember that investing in the stock market is not a get-rich-quick scheme. It requires patience, research, and a well-thought-out strategy. So there you have it, a brief journey into the world of stocks. The stock market can be a complex beast, but at its heart, it's all about buying a piece of a company and hoping that company does well. Understanding the stock market is all about grasping these fundamental concepts. So you've got the basics down, but how do you actually go about buying and selling stocks? Well, it's a dance between buyers and sellers, a dance of supply and demand. Let's break it down. First off, you'll need a broker. Think of a broker as your middleman, your translator in the world of stocks. They take your orders and carry them out in the marketplace. You tell your broker what you want to buy or sell, and they make it happen. Now, let's talk about supply and demand. It's a simple concept but a powerful one. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. This is the law of supply and demand at work. But how do you tell your broker what you want to do? That's where market orders and limit orders come in. A market order is like saying, I want to buy this stock right now, at the best available price. It's quick, it's easy, but you might not get the best deal. On the other hand, a limit order is like saying, I want to buy this stock but only at this specific price. It gives you more control, but it also means you might miss out if the price doesn't hit your target. Remember, the stock market isn't a race. It's a journey. It's about making informed decisions, understanding the risks, and being patient. It's about knowing when to hold them and when to fold them. It's about being a savvy dancer in the world of supply and demand. And that, my friends, is the art of buying and selling stocks. It's not just about making money. It's about understanding the market, making smart decisions, and playing the long game. Knowing how to buy and sell stocks is the first step towards becoming a successful investor. So let's keep learning and dancing together in this intricate world of stocks. You've probably heard the saying, don't put all your eggs in one basket. But do you know how this applies to the stock market? Well, the concept is quite simple. In the investment world, this saying translates into a strategy known as diversification. It's essentially the practice of spreading your investments across a variety of assets, sectors, or geographical regions, rather than concentrating them in one place. Picture this. You invest all your money in a single company's stock. Now, what happens if that company goes under? You lose everything. That's the risk you take when you put all your eggs in one basket. But what if you spread your investments across different sectors like technology, healthcare, and consumer goods? Or maybe you diversify across different geographical regions, investing in markets across the globe. This way, if one sector or region experiences a downturn, your entire portfolio doesn't take a hit. Now, diversification isn't about guaranteeing profits or completely eliminating risk. That's not how the stock market works. Rather, it's about creating a balance. It's about ensuring that potential losses in one area could be offset by potential gains in another. Think of it like a seesaw. If one side goes down, the other goes up. It's all about balance. And that's what diversification aims to achieve. You see, diversification is a key tool in managing investment risk. It doesn't promise a surefire win, but it does offer a safety net. It helps to smooth out the inevitable ups and downs of the market, protecting your portfolio from severe losses. So next time you're thinking about investing, remember to spread your investments. Don't just stick to one sector or one geographical region. Diversify. It's not a guarantee of success, but it's a smart way to manage the risks that come with investing in the stock market. Diversification is a key strategy for managing risk in the stock market. Ever looked at a stock market chart and felt completely lost? You're not alone. The world of stocks can seem like a foreign language, but with a little guidance, you can learn to understand the story these charts are telling. Let's start with the basics. A stock chart is a graphical representation of a stock's performance over a period of time. On the x-axis, we have the timeline, which can range from days to years depending on your focus. The y-axis represents the stock's price. There are several types of stock charts, each with its own way of presenting information. The line chart is the simplest, plotting closing prices over time to form a line. This gives you a quick visual representation of how a stock's price has moved. Next is the bar chart, which provides more detail. Each vertical bar shows the stock's price range for a specific period. The top of the bar is the highest price, and the bottom is the lowest. A small horizontal line on the left is the opening price, and on the right is the closing price. The candlestick chart, hailing from Japan, adds more depth. A candle is formed with two parts, the body and the wick. The body, the wider area, represents the range between the opening and closing prices. The wick shows the full range of prices within the period. If the body is filled, the stock closed lower than it opened. If it's empty, the stock closed higher. These charts, when read correctly, can reveal patterns and trends that can guide investment decisions. For instance, a steady upward trend may indicate a strong stock, while a downward one might be a signal to sell or avoid investing. But remember, charts are just one piece of the puzzle. They should be used in conjunction with other research and analysis tools to form a comprehensive view of a stock's potential. Being able to read a stock market chart is a powerful tool in making informed investment decisions. With practice, you'll be deciphering these financial hieroglyphics like a pro. So, we've covered a lot of ground today, haven't we? We've journeyed through the fascinating world of stocks, where companies and investors dance in a complex ballet of buying and selling. We've seen that stocks are not just pieces of paper or digital entries in a ledger, but are in fact a share in the ownership of a company. They signify a claim on part of the company's assets and earnings, and are a way for companies to raise funds and for investors to become a part of the company's success or failure. We've also delved into the art of buying and selling stocks. It's not just about spotting a company you like and hitting the buy button. It requires careful research, understanding the company's financial health, future prospects, and market conditions. It's about knowing when to hold on patiently and when to let go, always keeping an eye on the bigger picture. But it's not just about individual stocks, is it? We've stressed the importance of diversification. Putting all your eggs in one basket is risky. Spreading your investments across a variety of stocks can help minimize risk and maximize returns. Diversification isn't just a safety net, it's a fundamental principle of smart investing. And then there's the cryptic world of stock market charts. We've decoded the lines, bars, and colors that at first glance might seem like hieroglyphics. We've learned how to interpret these charts to understand market trends and make informed decisions. So, there you have it. The stock market might seem like a maze, but with these fundamentals it becomes a fascinating puzzle to solve. Remember, knowledge is power. The more you understand, the better your decisions will be. With these fundamentals under your belt, you're well on your way to navigating the exciting world of the stock market with confidence. It's a journey of discovery, a game of strategy, and a pursuit of wealth. So buckle up and enjoy the ride.